Hi, everyone. So today I'm with Dom, and we are going to be doing an earnings update for Oracle for Q4 of 2026. Dom, whenever you're ready.
All right, let me know you can see my screen.
Yeah, perfect.
Awesome. All right, so like Matt mentioned, going over Oracle's quarterly report today. Honestly, pretty good numbers. Beat on the couple metrics we typically are looking at, and we do have a couple other stuff I wanted to go over. So let's just jump right into it. Earnings per share is at $2.03 adjusted versus versus $1.96 expected, so a win there. Revenue is at 19.18 billion versus 19.10 billion expected, so good win there. The article does note that revenue increased 21% year over year in the quarter, which ended on May 31st. Net income rose 4.22 billion or $1.45 per share from 3.43 billion or $1.19 per share a year ago. Adjusted earnings exclude impact of stock-based compensation. Couple other things really quick. The company maintained previous revenue guidance of 90 billion for the 2027 fiscal year. They're just now finishing 2026, so they're keeping guidance the same. And says while lifting forecast adjusted earnings per share to $8.05. Analysts are projecting $8.01 per share and 88.9 billion in revenue. So not too bad. Still projecting to be higher than estimates, which is good. We did want to mention this. It says Oracle said it foresees raising 40 billion through debt and equity financing, including 20 billion share sale announced earlier. That's after raising 43 billion in debt and 5 billion in equity in fiscal 2026. And it says a move that concerned investors due to uncertainty about whether demand for artificial intelligence can justify the much new capital. So just something to keep in mind. Obviously taking on more debt can be helpful when you're trying to grow and expand, but it is something to always be cautious about, especially when people aren't sure if your debt needing for AI is going to be beneficial in the future. And then the last thing I wanted to talk about was this next paragraph down here, where it says the company called for $1.72 to $1.76 in adjusted earnings share for the first fiscal quarter, with 27 to 29% revenue growth. Analysts polled by LSEG had expected $1.68 in adjusted earnings per share, with $19.06 billion in revenue, implying a 28% growth. So they are saying they're going to do a little bit better than expected. Again, not too bad. There are other parts of the article that talk about their like current financial status and things like that, but I don't want to take too much away from Matt's portion. So I would just say overall for their last quarter, Q4 2026, did pretty good. Like I said, beat on earnings, beat on revenue, um, doing pretty good. Good guidance for the next upcoming year. So that's about it. So we'll switch over to Matt and he'll kind of take a look at how they're currently doing, and we'll see how that's going.
All right, thank you, Dom.
Thank you.
All right, so like Dom was saying, and give me a second, I want to share my screen with everyone as well. So we're going to take a look first over at Tipranks. And Dom, you could see this, right?
Yeah.
Perfect. So Tipranks is going to say, thankfully, there's no paywall here, but Tipranks is going to say it's a strong buy, 28 buys, 5 holds, 0 sells. We have 42% upside. It's at 183 right now, a low of 190, an average of 262, high of 400. And the analysts, which are also important, and I should mention the 5-star analysts, you always want to look that these analysts are correct. Like this guy's not as good. And he gave a buy rating, but this guy, Paul Chu, has a higher success rate. So you do always want to check that, just a little side note there. But it does look pretty good overall. Really no complaints here. It makes sense for Oracle. So the next thing we're going to take a look at is Oracle's 52-week high and low. We have it's at 184, 52-week low of 134, 52-week high of 345. So it's certainly not bad. It's certainly towards that 52-week low. 52-week high was 345, so it's really not that bad. Even at 184, I would say it's still pretty good for that. When we take a look next at Simply Wall Street, Simply Wall Street's going to say exactly what Dom was saying. Right now, we're right here, May 30th, 2026, those previous earnings. When we take a look at, let's say, for example, 2028 is going to say negative 41 billion because of CapEx expending. And then by 2029, looks like, I believe it'll be like Q4 for them. It'll be positive again in free cash flow growth. So there is finally a projection of when they'll be free cash flow positive, which is always a good sign. And it looks like their investment will actually pay off. To add that on. Next, we're going to take a look at their cash and equity. Right now, their debt is extremely high. as you could see here, it jumped from, so this is August 30th, 2025, so close to a year ago. It was at 91 billion. Now it's at 134. It dipped a little to 129. So it's like added obviously tens of billions more to their overall debt. So you do need to be cautious. It looks like they're paying it off. So it looks like the investments are working into AI and data centers, which they are investing in, but you have to be a little bit cautious nonetheless. Now, when we take a look at the net income again, like Don mentioned, and he was talking about quarters, but this is past couple of years is also very good. We have 2022 is 6.7 billion. Uh, Now it's 17 million. So in the past couple 4 years, let's say, give or take, it's more than doubled, which is excellent for a company that's about 500 billion, a little bit more market cap, which is large cap, a large cap or mega cap. Well, not mega cap, but it's a large cap stock, which is really good. And lastly, we're going to take a look at my DCF. My DCF is going to say it is undervalued by 45%. We have historical growth being overvalued by 38%. I do think it's undervalued. I would agree with Wall Street on this one. I think this capex spending it looks like actually it's paying off and it's going to be profitable, free cash flow wise, in 2029. So yeah, I don't really have complaints with this. I'm glad there's some kind of trajectory where they're going to actually be very good financially. Dom, is there anything else you wanted to add?
No, I think you did a pretty good job. I got nothing else.
Okay. All right. Thank you, Dom. Thank you, everyone.
Thank you.